Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
Hey everyone, welcome back to the Finance Garage, where we unpack the financial fine print so you don't have to. As always, Jonathan Wu, Senior Financial Advisor and Principal here at the SWU Group. Today, we're diving into a topic that doesn't really get much airplay, but can land a surprisingly large tax bill in your lap, otherwise known as Division 293 tax. Now, a lot of you may be thinking, oh well, I've heard of this, it's got something to do with people that earn lots of money, like $250,000 a year or above. Like, that's really not me, right? Not quite. You could simply be a regular professional, a business owner, or even an SMSF trustee and still get caught out, sometimes after just one big year. So, for the topic of the month, that's just little old me, we're going to break down Division 293 tax and demystify what it is and how it works. So Division 293 is an additional 15% tax on certain superannuation contributions. Specifically, it's targeting concessional contributions. Now, for those of you that understand the contribution structure in Australia, there are effectively two types that go into what we call accumulation funds. We have concessional contributions, which are made up of the contributions that your employer gives you, as well as any personal contributions, salary sacrifice contributions that you're aiming to effectively claim a tax deduction on. The way I like to generally explain it to clients is, of course, if anyone is gaining a tax advantage or a tax deduction by making that contribution into your super fund, whether it is your employer or yourself, those are going in as concessional contributions. The other type is non-concessional contributions, which has a higher cap and effectively is what we call after-tax contributions. In the case of Division 293, they are specifically targeting the concessional contributions, which as at the time of recording, which is April 2025, the cap every financial year is $30,000. Now, if in any financial year your combined income and superannuation contributions goes over that $250,000 threshold, then you are subject to pay this Division 293 tax. So normally, we all know concessional contributions like employment payments, salary sacrifice are taxed at 15% when they go into your super. But when your income plus those contributions exceed that threshold, being the $250,000, you get hit with another 15%, bringing the total to 30. Now, when those contributions actually initially go in and the initial 15% tax is being taken out, remember that you don't feel that because you don't receive a tax bill. It is taken out and remitted back to the ATO by your super fund. And in the case of an SMSF, it is directly remitted through your accountant and their paperwork ordering you to remit it directly to the ATO when that contribution is made. Now, you may think that the extra 15%, which we'll talk a little bit later on in terms of how it works mechanically, might sound harsh. But even at 30% total contributions tax, it is actually still better than the top marginal tax rate of 47% that high income earners face outside of super. Now, we all know the government's not silly. They will never legislate to put contributions tax at a super high rate of anything higher than 47%, because that obviously disadvantages or demotivates you to contribute money into superannuation in order to claim a tax deduction. So in round terms, if you are hit, or if you're, within the threshold of the Division 293 tax, meaning that you pay the 30%, does that discourage you from making contributions in order to offset your 47% marginal tax rate? Well, not necessarily, because while the original difference of 47 and 15 is 32% difference in tax, even at 30%, you're still have an advantage of around 17% being the difference of 47 and 30. So yes, it stings a bit, but superannuation contributions, never forget, are still a powerful strategy to consider, even in light of Division 293. So who pays the Division 293? So I've already said it's not just the ultra wealthy, and many people don't even realize they're affected until that tax assessment lands in their inbox. You can trigger this tax even if your usual income is under 250k. It only takes one unusual year. Maybe you had a large capital gain, sold an investment property, received a redundancy payout, or caught up on super contributions using the carry forward rule. If these events push your total income plus concessional contributions over that $250,000 mark, yep, you're liable, at least for that year. If we use a simple example, let's call it Sarah. Sarah earns $280,000 per year, and her employer contributes $32,200 in her super, which is the SGC. That is the concessional cap for 2024-25. If we then calculate her total income, which is made up of her $280,000 base salary plus the $32,200 in concessional contributions, her total income for the year is $312,200. In other words, that's $62,200 above the Division 293 threshold. But here is where it gets technical. The Division 293 tax only applies to the lesser of that excess amount, being $62,000, and the concessional contributions, which is $32,000. So in actual fact, Sarah is actually taxed an additional 15% on the $32,000, which works out to be $4,830. This is on top of the 15% tax her super fund has already paid on that amount.
Ready to take the first step in investing, or just looking to continue growing your wealth without being inundated with financial information? With SWU Online Invest, we offer a range of expertly managed portfolios designed to match your investment needs. Whether you're a seasoned investor or just getting started, know that we will work tirelessly to ensure your investments are strategically positioned to maximize your goals. Visit swuonlineinvest.com.au today.
If we slightly divert the topic and think about how this applies to SMSF members and why they should pay attention, is that if you're a member of an SMSF, this tax can sneak up on you. That's because SMSFs often involve active investment decisions and flexible contribution strategies. You may think you're safely below the income threshold for a few years, but then you sell an investment property, realize a big gain, receive a large payout of some sort, and suddenly you're over the line. Even using unused concessional caps from early years can backfire if you haven't projected your total income properly. One high income year can mean a Division 293 tax bill that you weren't expecting. We then come on to the topic of what actually counts as income. A common mistake is underestimating what the ATO counts as income when assessing for Division 293. It's not just your taxable salary. The ATO actually includes a broad range of items that includes fringe benefits, net rental losses, distributions from family trusts, lump sum super payments, and even realized amounts or released amounts from the first home super saver scheme. So your income figure could in actual fact for this tax could be significantly higher than what you see simply on your PAYG summary, especially if you're the type of person that has multiple sources of passive income that's not related to direct employment. If you then add in the super contributions, then you might be crossing that $250,000 line without even realizing it. Now, let's say you are hit with Division 293 tax. How does the ATO process, and then how do you pay it? Because that's the practical issue, okay? Because this impacts your cash flow, potentially, depending on how you go about it. Once you lodge your tax return, the ATO then combines that with information it receives from your super fund. Now, if you're over the threshold, they issue you a tax assessment. Now, you've got two ways to pay it. One, pay the tax using your personal funds. Or two, use a release authority to draw the money from your super fund. Now, as always, I'm just talking very broadly here. If you are looking and considering this for yourself, you obviously do need to talk to your financial advisor or reach out to your advisor if you are with us at the SWU group. The first option, which is paying it using your own personal funds, is a way that ultimately bleeds your own personal cash flow, which isn't great. So for someone like myself, who's relatively young, if I go and take option one and and pay it out of my personal funds, this is not a great option because I still have quite a number of decades before I can access my super. The counter argument to that, though, is that if I've got that extra money, using Sarah's example, that bill is, just under $5,000. Obviously, the offset is that if I keep the $5,000 within the superannuation environment, the highest marginal tax I pay there on earnings is 15% versus myself at 47%. So the key reason then why you would not pay it out of your own personal is because of cash flow. Option two, whether this is retail super, industry super, self-managed super, you can use the release authority to ask your super fund to pay that extra 15% on your behalf. Now, here's a warning though. If you proceed with the second option, being a release authority, you only have 60 days to get that release processed. If your super is managed within a self-managed super fund environment, you need to ensure this gets reported through the correct ATO system called MATS, M-A-T-S. Now, there is a special case situation, which doesn't happen all that often nowadays because these type of super funds largely don't exist, and it used to be the old defined benefit funds. If you're in a defined benefit fund, which are generally certain government funds or older employer schemes, things work a little bit differently. Because contributions aren't actually made to a visible super account like the ones that most people have today, the ATO uses something called notional taxed contributions to calculate your Division 293 tax liability. So this has got nothing to do with the change of assessment of that $250,000 threshold. This has to do with what type of super fund you have. Often, if you're liable for the Division 293 tax, the tax gets deferred until you retire or leave that job. But here's the kicker. It still sits on your ATO record, and interest may accrue if not addressed. So you need to speak to your advisor if you have a defined benefit fund and you are likely to be subject to Division 293 tax in any financial year. Check if that liability exists, whether or not that liability is due and payable now. And if it is, if you don't pay it now, will you or will you not accrue interest? Because that is a special area that is different from, I would say, 90% of the population who are in the accumulation fund system. To finish off, let's talk about some common mistakes to avoid with regards to Division 293. The first one is quite simple. Make sure that your MyGov details, and therefore your ATO personal portal details, is correct. Because if it isn't correct and not up to date, you could actually miss an important notice. Number two is incorrect income calculations. People often forget to include or remember fringe benefits or trust distributions as part of the 250K threshold. So that could lead to issues for people. Number three, reporting errors. So while nowadays the ATO has pretty good technology to capture most of your income, whether through employment or passive investment income vis-a-vis the pre-file system, Sometimes there could be mistakes made by a product provider. We've seen scenarios where fund managers have double reported the actual level of income paid to an investor in terms of interest for a given financial year. So these could potentially be double counted, lead you to go over the threshold when you really actually don't. And so this could lead to incorrect assessments, which could cost you dearly. Obviously, number 4 goes to number 1, which is don't ignore an ATO notice because these are time sensitive. As we mentioned, if you're in the self-managed super fund, if you are looking to use option 2, which is the release authority to release the funds out of your super fund to pay the extra 15%, you have 60 days to do it, so don't delay. And make sure, obviously, your records are good, because if your records aren't good, you've got much more issues going further down the line. The last point is make sure you've got a good forward plan and make sure your advisor is well aware of what that plan is, because if he or she is doing a good job, they will understand that there may become a time where you may trigger a large capital gains event that may push you over that threshold, which in that financial year could lead you to pay that excess 293 tax and hopefully find ways of potentially minimizing it, because the last thing you want, obviously, for anybody, is a tax bill surprise. So, as we all know, the Division 293 tax is now really a permanent part of the superannuation landscape now. And as income levels rise, because the $250,000 threshold is not indexed, there's going to be more and more people that are going to be liable for this. And as the number of people who are more active in dealing with their super, they could also be impacting more Australians. If you're an SMSF member, then understanding 293, how it applies and how to plan around it is critical. It's not just about, minimizing tax. It's about helping people make strategic, informed decisions aligned with their retirement goals. So that's all for this month. As always happy to take feedback at jonathan.wu@simonwu.com.au. You can always find me on LinkedIn and the other socials. And as always, please listen to the disclaimer at the end of this episode to remember that all the above that I've spoken about today is not personal advice in nature. Until next month, see ya.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SMU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.